Dave, welcome to the show. How are you?
I'm unbelievable. How about you guys?
I don't think we've ever gotten that answer. Unbelievable. I love it. What great energy. So for anybody who is listening to this and they might be new to the world of notes, can you just share at a high level, what is a note? Is it a mortgage?
It's
Is
a
it
musical
loan?
symbol. Come on. It's funny. My wife still can't explain to people what I did. She's like, yeah, he does this stuff. No, I mean, it is pretty simple. I like to say that we're all in the note business. And a lot of us don't realize we are because we're not actively participating in it. We might just pay our credit card statement, or we may send in a mortgage payment or auto payment. But we're kind of all in the debt business, whether we know it or not. It's happening all around us, in my mind. And when I look at around the room, I'm looking at everything in this room that you guys are sitting in has been financed by some company somewhere, or right, if you think about it. So I always say we're all in the note business. It's just we're looking at receiving payments instead of sending payments. And sometimes we can buy, distressed debt or delinquent debt at a discount. And it's one of the things that appealed to me about it at the time when I first got into it. I used to trade options. And one of the things that kind of turned me on about the note business was, hey, I can buy something at a discount with a high yield with collateral. So the collateral was the difference maker for me. So now, not all notes have collateral. I mean, there's unsecured notes like credit card debt, but you have student loan debt, you have auto debt, you have a lot of different types of debt. Believe it or not, I invest in a lot of different types as well on a personal level. But the company is all asset backed. So it is different in that regard. And it's something, with my real estate background being pretty, it's basically all I've ever done. I'm a firm believer in investing in what you know too, right? So I give that example sometimes. I had someone that had a heating and air conditioning business, and I was out to lunch with him. I said, have you ever thought of financing heater installations? And he's like, oh, you can do that? And in reality, that's the note business, right? And he went out and actually started to finance the heaters and air conditioning units, and he would get a deposit. A lot of times that would cover the unit. He'd finance the labor. And if you think about it, even if the party didn't pay, he could put a mechanic's lien on the property, right? So he's got collateral. So there are cases like that. And then I also had a dentist and orthodontist buddy who teamed up and formed a finance company for dental work, for example. Now, dental work's not really secured. You're not going to rip someone's fillings out if they don't pay or something. But that's similar to credit card debt. There's a default rate, and the interest rate's a little higher than whatever asset-backed rates would be. So it's all factored in. It's all statistical. So yes, it kind of started like that and morphed into all kinds of things. But really, on a personal level, I like, it's like my hobby is passive investing and all the alternatives. And I tend to like anything lending related or real estate related, or so I just play in those categories.
It's a very strange time right now. I feel like we're in this period of potentially facing recession. That's my personal opinion.
Yeah.
I think it's definitely on its way. Some say it already happened. Some say it's starting. I don't know. I mean, what are your thoughts? And then I want to take that and talk about the transition, because I know you're transitioning a little bit away from notes, and want to talk about the reasons behind that. So anybody who might be listening might get some insight from you. I know that when you're at conferences, this is a big topic that you regularly speak on. So would love to hear your opinion on this.
So I do cheat a little bit because I have a full-time economist on staff. So we have a market watch forecaster in our midst at PPR. So a guy named Spencer Staples, who's actually a forecaster. So I have the luck of walking down the hall and getting the latest of all the data.
You've got a crystal ball.
He buys a lot of data.
We need to get one of those.
So I am a little biased to his opinion sometimes because I get these weekly updates all the time. But to be honest, though, in 2006, I was starting to say the last single family rental I bought, guess what the interest rate was in 2006 when I bought that? It was 8% on that rental property. And my partner, John, gave me that loan, right? So it kind of gives you color as we're right there again at those rates, right? And when I started in real estate in 86, 87 was when I really started to become active. Rates were 14. right? And I had bought a primary residence. I was telling my son this. My son just bought his third property the other day. And I was like, and he was, complaining a little bit about the rates. I go, well, your dad, the house we grew up in when you were a toddler, I paid 11% and 6 points for that mortgage, but I still made money. I bought the house had burnt down. I rebuilt the house, and then I couldn't sell it, so we moved in it. That's really what happened. But but he's shocked at like, well, isn't 11% and 6 points like 17%? I'm like, yeah, pretty much. It's like paying a bookie almost. It's that high, right? So, but the problem I had was I was a contractor less than 5 years in business, and they were, clobbering me in points and fees, right? But I had to buy out a partner, and that was the only way I could do it. And I still made a lot of money on the property when I flipped it later. I ended up keeping it as a rental for 10 years and then sold it, but I made a lot of money on it. So even though I had high cost of capital initially, but the one thing that, when rates were really high, when I started out in real estate, that's when the adjustable mortgage came out. That's when the buy down came out. Those products didn't even exist prior to that. In fact, they didn't really have second mortgages that long ago. If you think about it, like when my mom got a mortgage, there was no second mortgages. So it's kind of interesting how the mortgage business evolved, and these products you're going to start to see some of these products surface again, I think, if rates continue to go higher. But I usually don't lose too much sleep on that, because if you have a good deal, you have a good deal, and you can always refinance. So the very first property I bought was a multi-unit in 1989, and I ended up building commercial garages on the property as well. I refinanced that property 5 times over a 30-year period, right? And I even paid retail for that property. I often tell that story where I didn't really get a deal. I paid retail for it. But after 35 years, it doesn't matter. It's ridiculous. Don't worry about it. It quadrupled in value. I refinanced it 5 times. I mean, don't worry. Don't lose sleep about some of that stuff. Because some people, they don't want to get in the game till they have the perfect deal, so to speak. And, it's not really required.